You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. Global markets are currently trading with a cautiously optimistic tone.
And that tone is being driven almost entirely by the accelerating momentum in peace talks between Russia and Ukraine.
Right, but this massive geopolitical shift is colliding directly with some really different central bank expectations around the world.
It's creating some fascinating volatility, especially in currencies and commodities. We'll be breaking down how the recent rate cut by the Reserve Bank of New Zealand is playing out.
And also those strong signals coming from the Bank of Japan and how all of that is impacting the broader U.S. dollar trend.
We'll also dig into how this macro optimism is supporting the S&P 500, even with these persistent regional flashpoints like the escalating tension we're seeing around Taiwan.
Understanding this delicate balance between politics and policy is absolutely crucial right now. Let's unpack it.
So that phrase you used, cautiously optimistic, that really is the key, isn't it?
It really is. It's doing a lot of heavy lifting because it's the core psychological anchor for all the risk-on behavior we're seeing.
It suggests traders are willing to buy, but they know just how quickly things could flip.
Exactly. Geopolitics is absolutely the dominant driver right now. The market is just running on reports that these Russia-Ukraine peace talks are finally moving.
Yeah, moving from just stalled discussions to, tangible progress toward a real deal.
And the specific detail that really kicked things off this morning was that comment from President Trump. The one suggesting a deal is very close. That's the kind of high-level headline that gets capital moving out of safe havens.
And you can see the immediate impact of that in the U.S. dollar.
Right.
The dollar index, the DXY, is still below that critical 100 level, trading softer.
And that dollar softness.
Yeah.
It's a combination of things, isn't it?
It is. It's a classic mix of two really powerful forces.
So what are they?
First, you've got the underlying belief that the Federal Reserve is staying on a dovish path. The market expects cuts next year. That's the monetary driver.
Okay.
Second, you have the potential for this major geopolitical de-escalation. So the market is just waiting for that rejection to happen, and that's what's keeping a lid on any real euro breakout. It's forcing traders to stay cautious.
Okay, let's pivot a bit, because while geopolitics is setting the mood, the central banks are really creating the volatility, especially in the currency pairs.
Oh, absolutely. The central bank divergence story is, I think, the most fascinating thing on the screen right now.
We have two totally different actions shaping the markets today.
You have the Reserve Bank of New Zealand cutting rates but signaling a long pause, and at the same time, strong signals from the Bank of Japan that they might actually tighten policy.
Let's start with the one causing the sharpest move, which is the New Zealand dollar outperformance. The Reserve Bank of New Zealand cut rates by 25 basis points down to 2.25%. Now, a cut should weaken a currency, but the Kiwi is flying. What gives?
This is a textbook example of how forward guidance is just so much more important than the immediate action.
Okay.
The cut itself, it was pretty much priced in. The real news was in the statement that came with it.
And what did that say?
The Reserve Bank of New Zealand effectively signaled a pause. They indicated they're going to hold rates at this level potentially all the way through 2026.
So the market isn't reacting to the cut itself, but to the idea that they're done cutting.
Precisely. It reinforces this narrative that their easing cycle is basically over, which puts them way ahead of other central banks.
Which makes the currency more attractive.
Exactly. It immediately caused a huge aggressive reversal in the Aussie dollar versus the New Zealand dollar. It just highlights that sudden gap in what the market expects from the two neighbors.
But wait, if they're signaling they're done cutting, doesn't that make the New Zealand dollar really vulnerable if there's a global slowdown, say in the middle of 2026?
That is the critical question. The risk is exactly that, a big and negative surprise in global growth. Their whole narrative only works if the world economy manages a soft landing.
So if demand collapses, they're stuck.
They'd have no monetary ammunition left without having to reverse course and, damage their credibility. For now, though, the market sees the Kiwi as a good candidate for carry trades.
Okay, now let's contrast that with the Bank of Japan, where we're seeing all this two-way volatility in the yen. It's a much more complex story.
The yen is being pulled in two different directions. Domestically, we had these reports that the Bank of Japan is preparing markets for a potential exit from negative rates.
A rate hike, possibly as soon as December?
Possibly. They're using forward guidance to smooth the transition.
How are they doing that? Is it just talk?
No, it's more than that. It's subtle shifts in their language about wage inflation. They're also hinting at adjusting their yield curve control targets, maybe getting rid of it entirely.
Which should strengthen the yen.
It should. But then that global risk appetite we talked about kicks in.
And the yen reverses. We saw the U.S. dollar climb back above 156 against the yen.
Exactly. It's the perfect illustration of the yen's conflict. It's caught between domestic policy tightening and global risk sentiment.
And when the market is chasing risk,
Capital chases yield. It flows out of the low-yielding yen. The huge gap between a U.S. 10-year treasury and a Japanese government bond is just too big to ignore, so the yen stays structurally weak.
and before we get to commodities, let's just quickly touch on sterling. It's also doing pretty well, just under 132, ahead of the autumn budget.
Absolutely. For sterling, it's all about the details in that budget, specifically this concept of fiscal headroom.
Fiscal headroom meaning how much space the government has to spend.
Right. How much unexpected tax revenue they have. If they announce big spending or tax cuts, that eats up the headroom, pushes up borrowing, and pushes up gilt yields.
And that affects the Bank of England's calculus.
It does. Higher borrowing makes the Bank of England less likely to ease policy aggressively. So, kind of paradoxically, a tight budget might actually be seen as positive for sterling.
Okay, this is where it gets really interesting. How are commodities and equities reading this whole mix? Let's start with oil. WTI and Brent are both softer. Why isn't oil rallying on this optimism?
Oil is fading yesterday's hope. The prices are pulling back because Russian officials came out with a much more cautious tone. They specifically said it's too early to confirm peace is near. That throws immediate doubt on everything. So oil traders are taking profits.
Okay, but in stark contrast, metals are moving higher. Gold is solidly above $41.50 an ounce.
Gold is benefiting from the things we've been talking about. A weaker U.S. dollar, lower treasury yields. That all helps. But there's another layer here.
Which is,
U.S. domestic policy speculation.
you're talking about the talk around Kevin Hassett possibly becoming the next Federal Reserve Chair.
Exactly. The market sees that as a potentially dovish outcome. The logic is that his appointment could mean a Fed that prioritizes growth over fighting inflation, which could mean lower rates for longer.
And that's classic fuel for gold.
It is. It's a hedge against currency debasement.
That's a fascinating link between a domestic political move and a global commodity price.
And you see it in industrial metals, too. Copper is climbing above $10,900 a ton.
Right, because of global risk sentiment.
That and also expectations that, better dialogue between the U.S. and China could support future industrial demand. Copper's strength suggests traders are betting on a cyclical upswing.
Which brings us to equities. European indices are green, U.S. futures are firm. Is this being driven by corporate earnings, or is it purely a macro story?
Oh, this is definitively a macro-driven rally. It's not about great corporate results.
Yeah.
The S&P 500 is drawing support from that trifecta of good news, falling yields, dovish Fed expectations, and geopolitical de-escalation.
And the market is pricing in rate cuts way out in 2026.
Aggressively pricing them in.
Yes. Are specific sectors benefiting more than others?
For sure. You're seeing continued strength in rate-sensitive growth stocks, obviously, but also in some cyclicals, like industrials, on the assumption that global trade will stabilize.
Okay, so let's put this all together for our listeners. We have this optimism, but the path forward is obviously not smooth. What are the big caveats?
Well, the Ukraine negotiations are the biggest one. They come with major disclaimers. President Trump can say they're very close, but the caution from Moscow is very deliberate. You can't ignore it.
What's the most important thing to watch for from the Russian side?
Their officials warned against premature conclusions. They're signaling that this isn't a done deal. The fact that Special Envoy Steve Witkoff is heading to Moscow next week is a huge signpost. It tells you this is a negotiated climb, not a straight shot up.
And while all eyes are on Eastern Europe, we can't ignore what's happening in the Asia-Pacific. The tension there is escalating, not decreasing.
Right. Taiwan is still a major focal point, and it's a powerful counter-narrative to this idea of global de-escalation. President Lin just announced a massive $40 billion defense package.
And it's aimed at accelerating the purchase of U.S. systems and developing what they call asymmetric capabilities. What does that actually mean strategically?
It's a huge shift. It means moving away from big, expensive targets like warships and tanks. Instead, they're focusing on smaller, mobile defensive systems. Things like anti-ship missile batteries, sea mines, cyber warfare.
So the goal isn't to win a conventional war, but to make an invasion just too costly to even attempt.
Precisely. It's about deterrence. And Beijing, of course, responded very sharply, warning it has strong determination to counter any foreign interference. So that fault line remains very, very active.
But amidst all that tension, we did get one small positive signal on the commercial side, with China buying U.S. soybeans.
And that is important. It's a tangible step. It shows that despite all the political friction, the economic ties are still vital. Economic necessity can, and often does, override some of the short-term political posturing.
So to summarize, markets are buoyed by potential peace and dovish central banks. But the geopolitical complexity, from Russia's caution to Taiwan, remains incredibly high.
Which leaves us with a final provocative thought for you, the listener, to consider. How resilient is this rally, really? If that geopolitical narrative reverses next week, if Russia walks away from the ceasefire proposal, would dovish Fed expectations be enough to hold up the S&P 500? Or would the flight back to the US dollar just overwhelm everything?
We appreciate you tuning in for this essential market update on the intersecting forces of geopolitics and monetary policy.
Thank you for being with us today. Join us again next time on the Financial Source podcast for more critical analysis.